Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's podcast. I'm so excited to have with us Michele Tucci, who is the MD Americas and Chief Strategy Officer of Credolab. We're going to learn about digital banking, digital credit, as well as the intersection between financial services, telecoms, and technology more generally. Michele, welcome to the conversation.
Thank you, Lex. Happy to be here.
My pleasure. Let's start off with painting the picture of sort of your career and your skill sets. Like when you look back at some of the foundational experiences that you've had, how do you frame them? What do you think of as the core that you've developed, to bring forward into entrepreneurship? What were those early experiences that really made an impression?
I think the starting point of my real career was when I joined Capital One in 2003. That was back in Italy, in Milan. And from a US point of view, Capital One was the largest credit card issuer in the US at that time. Italy was considered as an emerging market. Imagine that. So, and to some extent, from a credit standpoint, Italy still today is an emerging market. So people prefer to use debit instead of credit. They prefer to spend the money they have rather than borrowing. So at that time, I really understood the power of data to drive decisions. And that stuck with me for the entire career I had after Capital One.
Two questions on that. The first one is this really interesting behavioral question that you've brought up, which is, why do you think Americans use credit cards and what keeps them addicted to credit versus Europeans? The second question is, what did data look like in the early and mid 2000s?
Good questions. So from a behavioral standpoint, there are two considerations, I would say. One is really cultural. You spend what you have in Italy, and it's similar in France, Germany, Belgium as well. In the US, instead, you tend to want a bigger house. You tend to want a bigger car or a newer car. And the second point is about the financial ecosystem. I am new to the US. I've been in this country for about a year now, and I'm a thin file. So the credit bureaus don't have enough data about me to be able to score me properly. So I don't have enough credit history data simply because I haven't been in this country long enough. Now, I have tried it on my own skin, the almost vicious loop in which having a good credit score puts you. So I have applied for a credit card. I received a very low credit limit. And then I've started receiving offers of another credit card, and they were offering me slightly higher credit limit and also suggestions how to improve my credit score. So if I want to improve my credit score, FICO, for instance, I need to get more credit, but that's not enough. Once I have more credit, I need to keep my credit line utilization below a certain amount. And if I go above that amount, I am penalized. If I stay below that amount, then my credit score goes up. And it's a vicious loop because then I received a third credit card offer, which I took, and my credit score went up. Now, my challenge is to keep the average spend on each card at the same level. So at some point I read in the US, the average number of cards held by an individual was 25. So how do you then manage all of these different commitments? That's why I call it a vicious loop, because it's a self-fulfilling prophecy into debt to keep your score in good health.
That's fascinating because the idea of needing a good credit score is truly absurd, right? It's like, why is this the treadmill that I have to be on to artificially sort of maintain a score for borrowing? Why is this what I want to do? Why is this sort of socially and structurally encouraged? And you're right, the behaviors that are required like reward you for borrowing and having higher credit limits and then more borrowing and so on. I think in the US also you get this behavior around rewards and cashback, and also this like month protection where you can dispute transactions. So the customer is always right. You can just like decide not to pay for things after you've bought them through your credit card. And it's very, very sticky. It's not about payments. It's not about even sometimes like how much you can afford. It's about having this layer of cashback and protection and kind of living on the edge. That's weird.
And it's interesting you brought up the idea of affordability. I grew up thinking I'll buy something if I can afford it. In the US, it doesn't work in that way. No, you buy something even if you cannot afford it, which also makes me think about, maybe we're jumping the gun, but between transactional data and behavioral data, and what transactional data allows you to assess from an underwriting standpoint and what behavioral data allows you to assess. So even if you have a good salary, it doesn't mean you can afford to pay a particular loan amount or a credit card balance. So the question becomes whether a customer can pay and also is willing to pay. No? So there are two sides of the same coin, and that's what we are trying to solve at Credolab.
Before we get there, the other question was, the middle of the 2000s, Capital One access to data as a way to make financial underwriting decisions. Can you talk about what that data looked like, sort of like what was the infrastructure around it and how you've seen that evolve over time?
The decision-making process at Capital One was built around something called IBS, information-based strategy. At that time, there was no internet or very little. So the credit card offers were delivered mainly through direct mail. So the data we collected were around the conversion rates, and whether a yellow envelope led to a higher conversion rate versus a white envelope, whether having a gimmick in the letter itself converted more than not having a gimmick, or using icons versus in the letter itself, in the body of the letter, or having a plain letter or something that looked more formal. So it was all about driving conversions and testing what the right combination of credit line, credit limit, APR, card layout, and direct mail package would drive. It wasn't not so much about behaviors, about interests, about what kind of apps you use. It was really traditional data, I would say, based on what was available to us, and then optimized towards an offer that would drive conversions. Why? Because we tested all different permutations and we identified a winning one that we would double down on.
Later in your professional career, you've been at Mastercard. Was it a similar role, or how did that evolve for you?
Oh, Mastercard was an incredible experience. I spent about 5 years with them, started in New York, moved to Dubai, and then moved to Singapore with them. I was part of the consulting business called Mastercard Advisors, and I helped issuers of Mastercard credit and debit cards get the most out of these card programs. I remember one project in Nigeria, for instance, where we helped a bank issue the very first Naira-denominated debit card in the country. And what we found was a very particular behavior. People were curious. We issued about 1.5 million cards in the first 2 months. But then people were going to the ATM, withdrawing all the cash they had through the new debit card, counting the actual cash, and then going into the branch and depositing it again, because they didn't trust that the money was really there. So that defeated the purpose of issuing a debit card to lower transaction costs at branches and freeing up time of the people at the branches to focus on cross-selling or maybe deepening the relationship with clients. We fixed that later on. But Mastercard gave me the opportunity to do business in 42 countries, which was amazing. And all about new product launches and new market entry, portfolio optimization, and all sorts of projects to drive number of cards in force and spend with these cards.
If you think about some of the common motivators or incentives of different issuers and some of the common pitfalls or mistakes or problems, and by the way, that's a fascinating story about counting your cash. I love it. As you were helping different banks essentially deploy access to payment rails, how do they think about the payment rails? Was it entirely sort of functional and unemotional? Like, people have a deposit account with us, they just need a way to carry around that in their pocket? Or what was their view on the role of cards relative to the money at rest and deposit accounts?
I also worked for a bank, the largest bank in Italy. And when I went on the other side of the fence as a consultant, trying to help banks, risk managers, marketing people at the banks improve the way they did things, there was a common trait, which is we need to do this because that's what the market is doing. That's where the market is going. So it's not innovation per se, but rather innovation driven by an agenda that somebody else has put. And so why do you need to issue an affluent credit card? The justification usually is there is a higher interchange fee, higher annual membership fee, and therefore higher utilization and therefore higher revenue for the bank. The reality is that the business case was never built on how much money I can make if I issue a new platinum card, but was rather, okay, my competitor has a platinum card, perhaps issued by Visa. Now let's talk to Mastercard and see if we can match what my competitor does. And the same happened later on for QR codes or mobile payments. It was about matching what the competitors were doing. Why? Because Visa was pushing this faster than Mastercard was, or vice versa. So it was almost a catching up kind of game. And the challenge really is to go through the bureaucracy of these banks. In bureaucracy from now, it's perhaps even more prominent as a bottleneck: data privacy, data residency in some countries, info security because of mobile payments, what kind of token are you using, and security in general, cryptography for end-to-end communications. But that is just part of doing business with a product that is technological in nature. The way I see banks, actually, they are tech companies with a banking license. If the back office, the backend server stops, then the bank stops as well. So it is an IT company that is in the business of financial services. From a marketing standpoint, there was kind of a blueprint to push utilization, and before that, activation. So after a card is activated, then should be utilized. And after being utilized, it should be monitored to ensure that customers don't default. So, and if the customer keeps hitting the 80% mark of credit line utilization, then how do you assess whether to grant a credit line increase or not, whether that is a delinquent customer or a genuine one that is simply needing a higher credit line? So other challenges there. But to your point, there was a blueprint of customer life cycle that takes into account the current account or a CASA from a US standpoint as the core of the relationship. And then you can think of it as going to the left side in terms of satisfying the needs of saving, and then going to the right side in terms of satisfying the needs of credit. And the further you go from the center, which is your bank account and your debit card to withdraw cash. Then you have, on the right side, you have credit cards, you have personal loans, perhaps auto loans, and then a mortgage. So it increases the size of your credit needs based on where you are as an individual. And on the left side, you have a savings account, you have investments to protect your wealth and grow your wealth, and then all the way to pension needs. So the life cycle was very clear, and that applied everywhere I did consulting engagements in.
What did you learn about people and people's relationship to money? I think that it's a really powerful story of, here's the liability side of the balance sheet, here's the asset side of the balance sheet, and you've got these money movement sort of rails, and this is how they connect. But there's so much strange behavioral stuff going on, like people don't save, or they max out their cards and default, or instead of investing, they just trade and lose money in every market cycle. Did you come to see any profound insights about this financial human nature, having had all this access to bank data and payment data?
It is human nature. The idea that even if you have twins, one may be a saver, the other one is a spender. They were brought up in the same way, and yet their attitudes towards money, towards spending or saving may be completely different. I don't think I have come across a profound moment, a aha kind of moment to say, okay, this is the reality here. But it's about attitudes and preferences and the way that we react to stimuli from the outside world. I remember we launched in Australia with one of the banks there a tap and pay program. So if you tap 3 times, you get $5 back. If you tap 10 times, you get $20 back. So there are some considerations also about opportunistic behaviors versus behaviors that will change naturally. Am I going to use my contactless card? And this was 10 years ago. So today you can pay with your iWatch. 10 years ago, it was about tapping rather than swiping or rather than using cash. If I have a new card with contactless feature, am I going to use it simply because of the prospect of getting $5 back? In cashback, to your point earlier, or am I going to try it because I see convenience? So whenever a bank is launching that kind of incentive program, there are behaviors that will change anyways, simply because people see the benefit of using an electronic mean of payment over cash, and other people will just do it because of the $5. And then after they receive the cash back, they will go back to whatever behavior they had before. So where do you strike the balance also as a bank to incentivize behavioral changes versus wasting money in incentivizing a behavior that will not change over time? But in terms of attitudes, there are plenty of companies around doing psychometric assessments as a way to assess risk profile of people. And those are typically 25 to 30 questions about your attitudes. How do you see money? How do you see savings? Why do you save? Why do you spend? Why couldn't you resist to purchasing this particular item? And probably, Lex, you saw it also walking around with your partner, and she is drawn to a window and she just has to go into that shop. Some of these behaviors cannot be controlled, and to others may seem irrational. I think it boils down to human nature, not so much the way we grew up or the example that we saw from our parents, for instance. And you can see it even in children. Some display behaviors early on, and you wonder as a parent, how can it be possible, 3 years old with such a strong will?
Sometimes seeing the population level stuff is both confusing, but also deeply elucidating about where stuff comes from. I want to move us closer to talking about Credolab. I'm really interested in your experience with point of sale and kind of mobile payments, and your experience trying to figure out how to build payments between telecoms and financial companies, and in particular, and again, maybe I'm going in the wrong direction here, but one of the things that has fascinated me is that for different geographies, we already talked about the differences between the US and Europe, but it's fairly arbitrary who the power centers are for delivering financial services. In some places, it's going to be the banks and the government regulators. In other places, it might be the telecom companies and the money networks. In other places, it might be the technology companies and the hardware companies and, some government identity system. So I'm curious as to your experience observing how different players come together to create financial networks in different geographies, and then anything interesting you can share about sort of the different permutations that you saw.
I think you mentioned all of the relevant cases that pushed innovation or pushed innovation in payments. Like when you think of China and the size of the mobile payments network in China, that was driven by tech companies. No, it was driven by WeChat and Alipay. Now they have, I think, 900 million active users of this technology. And in the US, we are just in the last year or after COVID, we started using mobiles to pay wherever we go. Or the other one is in Europe, we had EMV network way before chip cards, basically way before the US did. The US adopted, you still have to sign for your debit card, which is not very safe. In Europe, you have to use your PIN code for every debit card transaction. To some extent, the US is still lagging behind in terms of adoption of new technologies. And in China, this was driven by tech. In Europe, more by the networks, Visa and Mastercard. In other countries, you just don't have the infrastructure, legacy systems. And so you jump to the latest technology. Mobile payments, there are two sides to the story. There is the issuing and there is the acquiring. You can push as many credit cards in the market, but if you don't have point of sale terminals to accept those cards, then you basically keep them in the wallets because there is no way to use them. So pushing mobile POSs, it was instrumental for Visa and Mastercard, for instance, to allow more people to transact with their cards. And I remember when I was at Mastercard, the CEO was Ajay Banga. He declared war on cash. He didn't see Visa as a direct competitor. It was, but the bigger competitor was actually cash. And therefore, and we go back to the idea of behaviors. If you are in the Gulf countries, UAE, Saudi, Qatar, where culturally you tend to prefer debit to credit, and you tend to prefer cash to debit simply because if you take out of your pocket a roll of money, a roll of cash, you display that you have money. But if you pay with even a debit card with a diamond on it, it's still a debit card and people may think that you don't have money. So as a status symbol, you want to pay with cash because that's how people recognize that you can afford to pay for something. Again, there is an intersection between behaviors, between cultures, between availability of technology, and then between regulation as well, that facilitates or not mostly the speed of adoption of a new technology.
There's just so much variety in the shape of how it comes together. Let's talk about Credolab and how that came together. What's the core problem the company's solving? How did it get founded to solve that problem? And where is it today?
Credolab solves one big problem that is a global problem for emerging markets as well as developed markets. The lack of data or a lack of good data to assess every individual. Today, we spoke about FICO, we spoke about the credit score from a US standpoint. In some countries, there is not even a credit bureau. There is not even a system to capture credit history worth of data. So what do banks do whenever they are in the presence of a new to credit kind of customer or a thin file, like I was a year ago in the US? they reject me because of lack of data. Some banks that have a higher risk appetite, they tend to approve, but with a lower credit line just to manage their risk. But still, it's a suboptimal situation for both the individuals and the banks alike. So we come in as Credolab, and our founder and CEO, Peter Barczak, was a chief risk officer before founding Credolab. And he identified this problem and tested different data, different sources of data, and identified that behavioral data coming from the smartphone devices, Android and iOS, if processed in the right way and with the right algorithms, could lead to a predictive score. So he founded Credolab in 2016 in Singapore with the objective of bringing standardized and clean and always equal and privacy consented and permission data to banks, to consumer finance companies, and then over time to buy now, pay later, to tech companies that are launching financial services. Since then, so it has been 7 years now, we have collected about 180 million data sets globally. We have scored about 21 million people globally across 38 countries. And we have some of the largest banks and neobanks and buy now, pay later players as clients that use our data and scores to make decisions in real time.
Can I double click on how the algorithm works, or, whatever it is that you can frame for us in terms of what types of variables are important, or, what are the insights that have been unlocked in this more behavioral approach? Because I think when you look at the traditional FICO scores and so on, like many AI models just found zip code to be something like 70% of the explanation of the underwriting. So can you talk about what's in the meat and potatoes there?
When mentioning zip code, redlining is not allowed anymore, especially in the US. There are a couple of considerations whenever you access data, whenever you build models that should be predictive and stable, but also they shouldn't bring bias into the decision-making process. You cannot discriminate based on ethnicity, gender, or zip code. As Credolab, we do not process any personal data. So we don't know whether Lex or Michele is applying for a loan. We know that we have collected this particular data set from an Android device, and we have calculated a percentage, a probability of that device to be similar to a confirmed fraudulent or risky device. And therefore, the probability of that device to default is 40%. Now, what kind of data we use? So first of all, we collect data only after we have received the privacy consent of the user and the permission to access data. Now, as soon as we have done that, we collect data of, let's say, we have access to the storage permission on Android or music on iOS, and we analyze metadata. So we look at how many songs do you have or have you played. We look at how many images or videos have you created in the last week or perhaps the 2 days before applying for this particular loan. We look at app ownership on Android. We know that if you have more than 13 apps in the finance category, you may be 2.6 times riskier than somebody with less than 5 apps in the finance category.
That's fascinating, because as somebody who runs a fintech podcast and newsletter, I have a lot of finance apps, which all of a sudden now makes me think I'm a bad underwriting risk.
Not necessarily. So we don't take only that behavior into account. We analyze about 10 million of micro behavioral patterns to identify those that are most predictive for risk and probability to default. So we look at the combination of up to 50 micro behavioral patterns that have high information value. So now we go into the more technical stuff, high stability and low correlation with each other. So we don't want to make a judgment on one behavior only, but we use a combination of those those micro-behavioral patterns to calculate the score. And the score becomes an input into the existing underwriting model of the client. So we are not here to substitute what FICO does or TransUnion does. We are here to complement the assessment of a particular individual with behavioral data. There are different benefits to that. So behavioral data, in our experience, has low correlation with transactional data. Think of open banking, PSD2 in Europe or PLED in the US. Low correlation with credit bureau scores. Low correlation with social demographic data, the ones that you provide as an applicant when you fill in the application form. So imagine we collect, and I think as of today, we are the only ones in the market that can collect keystroke patterns and UI interactions and analysis of gestures in the app. So on top of digital footprints coming from the analysis of the metadata of your operating system, we can also analyze the way you actually interact with the user interface, how fast you type, the typing cadence, how many seconds you take to type your name, how long do you hesitate before clicking on submit loan application, or are you hovering on that submit button and then are you scrolling up and checking your applications? If you do, how many times? So all of this is behavioral in nature. If we go back to one of the original questions, now imagine you and I, we have the same salary, we work in the same industry, we have a similar FICO score in the US or a similar credit bureau score. So from an affordability point of view, we both qualify. However, from a willingness to repay, according to Credolab score, Lex is willing to repay and Michele is not. So by combining different sources of data plus Credolab score into one decision, you are able to reduce number of false positives and false negatives. Basically, you can approve more people and also keep risk under control.
That's super interesting. It's your digital avatar, the reflection of yourself in negative behavioral space is enough to impute the personality characteristics that make somebody deserve a loan. It's wild to hear. Do you have a caricature of the very confident person who just fills out the form and clicks submit is, trustworthy, and the person who's neurotic and 10x checks every single thing is going to be a bad risk? Is there a version of that the company keeps, or is it much more contextual than that?
Interesting that you go in that direction, because this is a product that we're working on as we speak. We have hired a behavioral psychologist. He is looking through the data sets we have and actually identified a framework to predict your personality type based on the way you use your mobile phone. And so this is not about risk now. This is about marketing, a marketing use case. And imagine we are using a framework called OCEAN, or a Big Five personality types. OCEAN stands for openness, consciousness, extraversion, agreeableness, and neuroticism. Based on the analysis of the way you use your, for instance, the brightness of your display or battery level, how often do you charge your mobile? Or do you charge it before going to bed, for instance? Or you forget and you run low on battery during the day? What kind of apps you use or how many selfies you take? There are about 70,000 data points that we analyze. And again, without knowing that you are Lex or Michele. No, we are simply analyzing a data set without being able to connect it with the identity of a user. So we will be able to predict your personality type and therefore recommend to our client how to communicate with you, how to best communicate with you. In terms of messages, some people will want to have social proof as a way to encourage them to click or to apply for that particular offer. Some people will respond better to an image of a monkey, for instance, or an image of a baby. So the idea is that we can leverage the same data that we are processing today for risk assessment and fraud prevention to enable a marketing use case that aims at converting people better.
It's wild stuff. And I think we'll only have more and more of our digital footprint online. And I think like people don't really understand when they interact with a mobile device that they have this like software octopus sitting around their head, figuring out all the things that they're doing, and that those things are actually quite meaningful. And those patterns might not be understandable to us in the physical space, but in the digital space, they are discernible. And of course, it's comforting to hear that privacy and consent and anonymity is built into your platform and what it is you're doing. I guess
from the ground up.
Yeah, I imagine it has to be, especially given the European markets and GDPR and so on. As a closing question, I'd love to ask you a forward-looking question about how you see these types of approaches to accessing financial services developing, and what their role will be relative to more traditional finance approaches, as well as the role of banks. And we have this context now of generative artificial intelligence, of internet scale, machine models being able to generate realistic human outputs in terms of language, in terms of visual objects, and I'm guessing soon enough financial characteristics are as easy to fake as somebody's portrait. How do you see that arms race going forward? How do you see the development of, on the one hand, the data and the imprints that you're leveraging today for your product, and then on the other hand, the AI products that'll eventually rise out of it, and then the role of banks within that mix?
I think it's inevitable that this will become even bigger. Data is digital footprints that we leave behind is massive and rich of insights. For me, as long as we extract insights that are valuable to the end user, and we're not taking advantage of the permissions that we've been granted to access their data, then it's only for the greater good. We are talking about financial inclusion. We're talking about fairness in the risk assessment or improved fairness. So by mining this data, we're able to include more people into a fairer financial ecosystem. Then it's a win-win for everybody. What I see and what I hope for is also an increased regulatory oversight on this kind of data. Interestingly enough, of all the countries where we operate, you mentioned Europe, but actually Indonesia is the one that has implemented a framework to learn. The Financial Services Authority of Indonesia, OJK, has implemented a regulatory sandbox where they test new technologies, and Credolab has been selected as a role model for the way we process smartphone device metadata and the way we calculate scores that are used by banks in the country to score people in real time. Credit bureaus in Indonesia have less than 30% penetration. So what about the other 70% of the population? Do you leave that outside of financial services? That's not fair. So for us, if we have regulators that want to learn about smartphone metadata, we are keen, happy to work with them and explain how this can be done in full data privacy protection. Think about this also, Lex. I'm sure you have TikTok on your mobile and Instagram. You are giving away a lot more data than you may realize in exchange for what? To see a more targeted banner in your news feed or whatever the Instagram calls it. We are doing something else. We are not monetizing your data to show you ads. We are monetizing data. I mean, we're not a charity organization as Credolab. We're a SaaS business, but we are selling scores that may give you a better chance or fairer chance of being approved for the loan you deserve.
Absolutely. I think the more people can understand what it is that they're actually opting into, and then what's available to them if they do it, and whether that trade-off is worth it, the better. This has been a fantastic conversation. And if our audience wants to learn more about Credolab or to find you, where should they go?
Oh, my email is mtucci@credolab.com. I'm on LinkedIn as well. I'm happy to talk to your audience and answer questions they may have.
Fantastic. Thank you so much for joining us today.
Thank you, Lex.
Hi, everyone. That's it for this week's episode of the Fintech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.